Ever wondered why construction accounting feels like a whole different beast compared to regular business finances? Well, grab your coffee because today we're diving into the wild world of construction accounting, and trust me, it's not your typical story. Let me start by painting you a clear picture of what we're dealing with here. Think of construction and regular accounting like distant cousins. They share the same DNA but live completely different lives. While 80% of businesses follow standard accounting procedures, construction accounting makes up about 15% of specialized accounting practices, with manufacturing taking up the remaining 5%. These numbers alone tell us something very important. Construction accounting is unique enough to deserve its own category. This might be an unconventional example, but bear with me on this. Think about regular accounting as running a wedding dress shop. You've got a fixed location, predictable inventory, and straightforward sales. Every day, you know exactly where your merchandise is, what your overhead costs are, and when the money is coming in for the most part. But construction accounting, it's more like, juggling flaming torches while riding a unicycle. You've got multiple projects happening at the same time, different locations to manage, and variables that change faster than weather in spring. Let's dive deeper into what makes construction accounting so special. If regular accounting is like keeping track of your monthly household budget, I feel like construction accounting is like managing 10 different households at the same time, each with its own mortgage, utilities, and grocery lists. And these households, they're all in different stages of being built. Here's a real-world scenario to help this sink in. Let's say you're Johnson Construction, and you're currently managing 3 different projects: a luxury home built, $900,000, a mid-range home about $500,000, and starter home at $300,000. For each of these projects, you need separate tracking systems for materials, labor costs, equipment expenses, timeline management, and profit calculations. But it gets even more complex because these projects are all in different phases. The luxury home might be in the foundation phase, requiring heavy equipment and specialized labor. The mid-range home could be at the framing stage, where lumber prices are fluctuating weekly and multiple contractors on site. And the starter home is in the finishing phase, where detailed work requires skilled craftsmen and expensive finishing materials. Each project has its own budget, timeline, and profit margin to track. Now, let's talk about decentralized operations, another unique aspect of construction accounting that regular accountants never have to deal with. Unlike a retail store where everything happens under one roof, construction companies are literally spread across town or sometimes even across states. You might have 5 different crews working on various projects, equipment spread across multiple sites, materials being delivered to different locations, and subcontractors coming and going like it's Grand Central Station. This creates a whole new level of complexity. Take equipment tracking, for instance. Let's say you own a $150,000 excavator. In regular accounting, that's a simple fixed asset with standard depreciation, but in construction accounting, that excavator might be used on 3 different job sites in a single month. You need to track not just depreciation, but also which project is responsible for what portion of the costs, including fuel, maintenance of that equipment, and operator time. I know it sounds like a lot, right? Let's switch gears and look at regular accounting in more detail. Remember our wedding dress shop example. Their accounting is beautifully straightforward. When they buy dresses, it's a simple inventory purchase. When they sell a dress, it is immediate revenue. Their staff costs are fixed, their overhead is predictable, and their location costs are stable. They deal with consistent inventory levels, standardized pricing, and regular payment cycles. The biggest excitement might be maybe end of the season sales or annual inventory counts, but construction accounting, that's where things get really interesting. Let's break down a typical project to show you what I mean. Take that luxury home build I mentioned earlier. Your costs might include $200,000 in materials, but those materials aren't all purchased at once. They're buying them in stages with prices that might change between when you bid the project and when you actually need the materials. You've got $150,000 in labor costs, but that's spread across different pay rates, different crews, and different phases of the project. And in $75,000 in equipment costs, $25,000 in permits, $50,000 in subcontractor fees. You're juggling the numbers so fast. Progress billing adds another layer of complexity that regular accounting doesn't deal with. In your wedding dress shop, payment is simple. Someone buys a dress, they pay for it, but in construction, you might be billing in stages: 20% groundbreaking, 30% when the framing is up, another 30% when the interior is complete, and the final 20% after the walkthrough. And don't even get me started on retainage. Holding back 5 to 10% of each payment for months after project completion is a concept that could make regular accountants scratch their heads. Modern construction accounting has evolved to meet these changes, and technology plays a huge role. Today's contractors aren't just using basic accounting software. They are implementing comprehensive project management systems, mobile apps for time tracking, cloud-based document management, and real-time cost tracking systems. These tools help manage the complexity, but they also require a different understanding of both construction operations and accounting principles. I am linking down below 2 of my videos about the tools that I use for my own business and for my clients that are very necessary. Let's talk about something that keeps many contractors up at night as well: change orders and their impact on accounting. Unlike regular businesses, where a sale is a sale, construction projects evolve constantly. Imagine you are halfway through the luxury home build and the client decides they want to upgrade all the windows to, let's say, hurricane-resistant glass. This single change affects so many aspects of your accounting. First, there's the material cost difference, maybe an additional $30,000 for the upgraded windows. Then there's the labor impact, which installation takes 30% longer than standard windows, affecting your crew scheduling and labor costs. You might need specialized equipment for installation, adding another $5,000 to the project costs. For single change order, it needs to be tracked separately while still being integrated into the overall project accounting. Here's where it gets even more interesting: timing and cash flow. In regular accounting, you typically deal with predictable payments terms, but in construction, change orders can create significant cash flow challenges. You might need to order those special windows with a 50% deposit, but your change order payment terms might be net 30 or even tied to the next progress billing. This timing difference can create serious cash flow pressures that regular accounting systems aren't really designed to handle. Speaking of cash flow, this is another thing that construction companies need a lot of help on the financial side. Oftentimes, the materials are financed by the construction company itself, and all the labor paid in advance way before they ever get paid by the client's bank draws. So accountants need to keep a close eye on the cash flow so the business doesn't go under when it cannot pay its bills. Now let's talk about different methods of bidding and invoicing. Nowadays, there are even more variations than your simple cost plus and fixed price. And every one of them has a different process for invoicing. Whether it's progress invoicing or through billable expenses, the process can be built out for each business owner specifically to how he does things in his business. That's important. Another critical aspect that sets construction accounting apart from is complexity of payroll. In regular business, payroll is relatively straightforward. Employees work at one location, usually at fixed rates. But in construction, you might have workers moving between multiple job sites in one single day, each with a different pay rates based on the type of work being performed, and in prevailing wage requirements for government projects, union regulations, and that certified payroll reporting, and you've got a payroll system that requires specialized knowledge and careful tracking. You also need to track the hours by project to make sure that you can properly job cost that labor. Regular businesses typically have straightforward insurance as well: property, liability, maybe some professional coverage. But construction companies, they need to manage project-specific insurance requirements. Your performance bonds, payment bonds, workers' compensation insurance, that varies by type of work, equipment insurance, builder's risk policies. Each of these costs need to be allocated properly across projects and tracked for both billing and tax purposes. One final aspect that deserves attention is long-term nature of construction warranties and guarantees. Unlike a retail sale where the transaction is complete once the customer leaves the store, construction projects can have warranty obligations extending years into the future. This requires setting up warranty reserves and tracking potential future obligations, something that regular accounting rarely needs to consider. Here's a real game changer that many contractors don't realize. Proper construction accounting can actually predict and prevent problems before they happen. Let's say your job costing system shows that your labor costs on the current phase are running 20% higher than estimated. In regular accounting, you might not catch this until the monthly financial statements. But in construction accounting, you can spot this trend early and make immediate adjustments to keep your project profitable. Before we wrap up, let me share some crucial moments every construction company needs to remember. First, construction accounting isn't just about tracking numbers, it's about creating a financial roadmap for your projects. Second, each project is its own financial entity requiring individual attention and analysis. Third, embracing technology isn't optional anymore. It's essential for staying competitive and maintaining accuracy. And finally, accurate job costing isn't just about knowing your costs. It's about understanding how those costs impact your bottom line. I want to leave you with a real-world example of why this matters. I recently worked with a contractor who was using regular accounting methods for construction business. He thought he was making 15% profit on every project project. But when we implemented proper construction accounting methods, we discovered he was actually losing money on some projects while making up to 25% on others. And that insight allowed him to adjust his bidding strategy, choose the right niche, and increase his overall profitability by 20% in just 6 months. If you found this video helpful, don't forget to click that button to subscribe to our channel. Until next video.